Good morning everyone and welcome back to Morning Markets on Tuesday the 5th of December. I'm Kevin Kidney. Today we'll focus our discussion on comments from Jeff Casson, our CIO, yesterday, and we'll expand that out to what's going on in China. So as Jeff Casson mentioned yesterday, November was a remarkable month for portfolio returns. In economic terms, financial conditions in the US had the strongest easing in 40 years. That really means broad-based and positive returns from equities, bonds from both governments and corporates, and for non-dollar currencies globally. So very, very strong. And it was the US, Europe, UK, Japan, and most emerging market economies who participated in that asset class rally. However, one economy that didn't is China. And that really reflects the domestic pressures the economy there is facing. We've spoken before at length about the post-COVID woes of China, but let's delve deeper today into the headwinds they are facing. For context, the Chinese economy has expanded 300% since the global financial crisis 15 years ago. Most of that activity has come from residential construction financed by credit expansion. That is, banks have lent in order for buildings to be constructed. However, since 2020, authorities there have clamped down on credit expansion, such that we've seen remarkable declines in construction activity and also the appetite to purchase new buildings. Now, for an economy which is so dependent upon this activity to fuel GDP growth, it's difficult to believe ongoing official statistics that suggest the economy there continues to grow somewhere between 4 and 5%. It's actually likely that China is in what we would normally describe as a recession. We are seeing falls in the selling of new floor space back to 2010 levels, and new construction activity has fallen back to 2008 levels. These are declines of over 50%, so it's highly unlikely the economy there is growing. What are officials doing to try and reorient the economy? Well, they're focusing more on manufacturing activity. But of course, China already is the world's global manufacturer and supplier of finished goods, and the global economy is actually slowing. The US remains strong, but activity growth there is decelerating, and we know that GDP growth in the UK and Europe, for example, has been difficult this year. So it's very difficult for China to reorient from residential construction towards manufacturing if the rest of the world is slowing and the appetite for purchasing goods is declining. So China remains in a difficult spot, but the rest of the world remains in growth, and this is what has supported asset class returns and given us such strong portfolio returns this quarter. And that is why most managers that True Potential have been underweight China this year. So it's been a strong quarter so far for portfolio returns. China hasn't participated. Please join us tomorrow where colleagues will update you on activity from the US and Europe. Thank you.